Hi, this is Lex, and welcome to the Fintech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Ajit, welcome to this conversation. I'm really excited to dive into the intersection of fintech and DeFi with you.
Thank you so much, Lex. It's my pleasure.
So, disclosure up front: we used to be colleagues, so I'm already positively prejudiced.
Likewise, so am I.
Uh, but maybe we can just start off with, you've had a fascinating career arc, and I think it's almost kind of it's almost a mirror of what's happening to the actual financial services industry. Do you mind just kind of plotting that journey from the traditional finance consulting worlds through ConsenSys, through the nosebleed section of the DeFi protocol innovation that you're involved in now?
Yeah, absolutely. So, I started in the middle of the dot-com boom in 1998, and how appropriate it is for the time we are in crypto, right? So, and I started as one of the H-1B exports from India to the US. I saw the ball drop on Times Square, and this is when the the internet was a bit like crypto. There were lots of interesting companies coming out, but no real business models. So this whole software is eating the world thing hasn't really happened, and Wall Street was still the dominant industry at that time. If you wanted to find rich people, you went to Wall Street. If you got an MBA from a top school, you went to Wall Street. If you wanted to marry your daughter after someone, you went to Wall Street. So Silicon Valley wasn't quite what it became, right? And then at that time I was doing like deep end of telecommunications and network engineering for Belcore. I was a very hands on. I was actually a pretty decent programmer back in the day. And
That's still with the the paper cards, and you got to twist the crank and wait
no, no,
overnight,
no,
right?
no. I'm only a half boomer, not a full boomer. so, so yeah, so in 1998 is when the Netflixes of the world were starting to talk about streaming, while we were all still using dial-up, and even that feels a bit like how Ethereum is today, and that's why I can relate to this space. And it's in 2001, 2003, after the crash, when my millions went to thousands, I ended up going back to India to work for a very, very interesting firm. Did some very interesting architecture work, and then joined Goldman Sachs. That was my first tech job in the financial industry. I was doing compliance systems, risk systems, and so on, and ended up in Tokyo running all of the market and credit risk.
Were you doing the compliance and the risk systems as a developer or as a sort of a
Uh,
business analyst? Or
yeah, I started as a developer, but then bad things happened to me, right? They started promoting me and stuff, and I became a bit of a manager, and quite a few bad things happened there. And they started paying me a lot more and whatnot. So at Goldman is when my financial industry journey really started, and this was also the time when Wall Street was at its apex, right? 2007, 2008. And Wall Street was dominating this around 2009, 2010, when the financial crisis was at its bottom. I made a wrong turn, and I ended up going to business school instead of actually continuing with a tech software development career. And look, that was terrible timing, because anyone who took a different turn and went to Google ended up being in a very different place in terms of so when
we've made very similar mistakes, because I was at Lehman up till '08, which was very educational, and then I also ended up going to grad school for 4 years.
oh, what have you done?
Yeah,
Right,
yeah.
right, right,
So
right, right.
lots of great choices all around.
Yes, yes, but look, I wasn't listening to Mark Andreessen back then, and I am now, right? So So 2010 is when Mark Andreessen came out with this whole software is eating the world narrative, and at that time I was sitting in the middle of business school, a Swiss business school, a school at that with great food, and lots of blah blah, and then I didn't want to go to strategy consulting because my we just had a 1 year old kid, and a lot of people who went to strategy consulting don't have the same kids anymore. So
Yeah.
yeah, there's a lot of travel and all that. So I ended up going back to Barclays doing risk tech again, and then the LIBOR thing hit us, right? And Barclays got rid of a whole bunch of bankers, quants, and basically my kind of people, right? So people who were at the deep end of risk and whatnot, and that's when I went. That's when I did a bit of odd jobs in the middle and got hired by PwC in the middle of the reg boom, right? So 2010 onwards is when 2014 is when if the compliance people were in demand. If you weren't doing compliance, then what on earth were you doing with your life? So there were lots and lots of regulatory change projects everywhere and so on, and there was everybody was trying to audit everything, whether risk reports, regulatory reports. So auditors and lawyers were in demand, and everybody else, all the engineers outside of Silicon Valley were basically not in demand. And as a tech guy, I got really bored doing that. Some of the audit stuff, and that's when I started doing something that no one else wanted to do, which was to build a blockchain capability inside an audit firm.
Yeah.
And that was one hell of a move. I mean, I did it because nobody else wanted to do it, and there is no glorious story behind it, right? I mean, I can create one if you like. But that turned out really well because I got sucked into the rabbit hole. The technology was fascinating, the applications and potential of all of the tech was fascinating. But that was the time when everyone, Mike Hearn was rage quitting Bitcoin and selling off all his Bitcoin at $400, and doing DLT being distributed ledger technology.
I don't think you're allowed to say DLT in
No,
public
no, no.
anymore. I mean, actually, it depends. I think some places you're only allowed to say DLT.
That's correct. That's correct. So, but that's changing very fast, right? So that was the time when blockchain was kind of this thing that people do. I mean, weird people do, and DLT was the thing that people who wear suits and iron shirts do. So I was doing DLT, and I was doing it pretty well. We did a lot of work on VTrade, which was the first trade finance platform to go in production. Then did this incredible project with Bank of England, and once you have a client like Bank of England, you kind of reached a high point in your DLT career, right? I mean, it's the Bank of England. So and I ended up and again, when I describe my career, it sounds more like drifting. Maybe there is some truth to that. So I met Joe at ConsenSys, and Joe was essentially hiring anyone who was any good at blockchain or was known for blockchain. Lex, you know that story, right? So Joe suggested maybe I should come on board, and Joe is an incredible charismatic leader with a deep sense of mission, truly inspirational. So it was hard for me to say no to that, and that's how I ended up at ConsenSys, and that's really the beginning, I would say, at the deep end of blockchain.
Um, it's a fascinating story, and I think it's also quite universal. One of the things that when I started having like my flirtations with ConsenSys, one of the things that just struck me was that it was this tribe of people who um, are outcast is the wrong word, but who are weird and all in very similar ways.
That's the word.
Who and it's really fantastic to find your tribe. And I think now the space has gotten so much bigger, right? So markets go up and down, and Ethereum, ETH is whatever it is, 50 billion, 100 billion, 200 billion,
Mhm.
10 trillion, whatever it is. As the space changes, it opens up different types of tribes of people who are all bought in, but they have very different stories for why they're bought in.
Mhm.
And in 2021, the I think the profiles of these different tribes, are quite different.
Hmm.
Where you do have now large groups of people who've committed millions, if not billions, of dollars in
Hmm.
traditional finance
Yeah,
to build out blockchain based markets. You can call them consortia, you can whatever you want to call them, but they're venues, they're markets, they're blockchain based economies, and there's an attempt to turn them into walled garden and so on. But there's that's one profile. There's the profile that I think most closely aligns with me, which is I think the bridging is really important,
yeah,
which is that you've got the fintech vector, and you've got the high tech AI vector, and you've
yeah,
got the blockchain crypto vector, and
yeah,
then you've got the traditional assets vector,
yeah,
and all these things are ingredients in a soup,
yeah,
and the magic is the context. And so, like
yeah.
for me, I like to contextualize all this stuff.
Yeah, yeah,
But then,
and
of
you and
course,
I are
you
the same in that sense, right? So we
yeah.
translate all this and make it accessible for a lot of people who are trying to make sense out of this incredible pre-Cambrian explosion of innovation that's going on in crypto. And I think that translating that for people who are trying to build a bridge to this new world that's coming, I think that's definitely been something you and I have done for a while now.
So then there's the next the other group of people, which is much more who are really in the mountains, setting up camp, trying to get to the top, who are pioneering and only pioneering the kind of the decentralized finance edge, and everything else is history.
Yeah.
It's like the horrible uh, it's like the Star Wars prequels, right? The everything's history.
Yeah, yeah,
The past is dead.
and it turns out, those are also the biggest value creators and value capturers,
Yes.
if that's the word. Who's
Yeah.
getting rich? The devs are getting rich, right? I mean, and there is something really interesting about that, and a lot of people are confused by that. But there is a
So let's
yeah,
kind of let's pause on that for a while, right? Which
right,
is you've gone after doing this consulting work and building out these bridges. You've been more recently at Binance and now at Aave,
yeah.
and interacting much more directly with the DeFi builders. So tell me a little bit about the nature of that work, the personalities involved, and what you've learned sort of from a qualitative perspective.
Yeah, so when I left ConsenSys at the end of last year, and ConsenSys was a phenomenal, truly enjoyable journey. I learned an incredible amount from so that was kind of my redemption as a technologist, if you will, coming from banks and then PwC, and then going back to ConsenSys. And ConsenSys is is kind of holds that Web3, the next generation internet mission, very close to its heart. And for me, it was kind of like being back in the internet tribe, right? And DeFi is kind of just a continuation of that. So when I left ConsenSys, I think it was pretty clear to me that this whole enterprise blockchain DLT thing was an idea whose time had kind of that wasn't really working. As in, this idea of creating a diluted, closed environment version of blockchain, you couldn't have it both ways, right? You couldn't be away from the open internet with all its modulations and try to capture the benefits that this permissionless open internet gives us today. So that was pretty clear to me philosophically and otherwise, and I started consulting because I didn't really have crypto creds at the time. I was seen as a blockchain guy. And I started consulting with a crypto custodian and with a few other firms. I was lucky to do this bridging role for Binance, where I was essentially building fiat on ramps, right? Building banking and payments partnerships for Binance. And so my background in traditional finance and sort of understanding regulation, compliance, everything, the details of KYC, AML policies, everything was incredibly helpful in building a bridge between centralized crypto like Binance and traditional payments world. Being a fintech person, I think was incredibly helpful, and that took me to another firm later called Paxful. Paxful is one of the most interesting firms in the world of Bitcoin. They essentially enable peer-to-peer transactions, and a lot of their customers are in Nigeria. We talk about financial inclusion and exclusion, and Paxful's customers are the ones that Bitcoin was designed to serve, right? And that was truly phenomenal for me to experience that for a few months. And so and with all of that, background on both sides, and the network, the expertise and community, and Stani and I and a few other team members and I kind of go back a long way in the Ethereum community. We started thinking about how we can, and we share a few communities, and we started thinking about what does DeFi look like in a few years time, right? And how do we get institutions to participate? How do we scale DeFi from where it is? How do we help mature DeFi from
Can
where
you
it is?
just pause to define DeFi in your own words here?
Yeah, definitely. So DeFi stands for decentralized finance, right? I don't think the finance is new. I think the financial instruments, the risks, the everything is the same. When I, as someone educated in finance, I think the finance is not new, but the architecture is very new, right? So decentralization has two parts. One is the technical decentralization, which public blockchains facilitate, where you're sort of saying, look, this blockchain is not controlled by a bank. The technology is infrastructure is not hosted by a bank. It's not five guys in a data center that's managing this thing. So that's technical decentralization, where you sort of deploying a distributed financial service on the open internet. And so and then there is economic decentralization, right? Which is, so if you look at the Aave protocol, it's not controlled by Aave team or founders. It's governed by the community. Any decisions of any salience are made by the community. And the community comes in two forms, right? There is the Aave token holders who vote on proposals, and then there are the wider community that are interested in the growth of DeFi, and that's pretty much everybody. So decentralized finance is basically a set of distributed financial applications deployed on the open internet, which are governed by community, and not by a centralized entity, right? So that's how I define DeFi.
Cool. Okay. Um, so one piece of context that I think is orienting for me is just how capital markets oriented um, DeFi is today. Just in terms of like the overall value chain, right? Like we often, especially on the fintech side, which is so strong in B2C and in the consumer experience, where the endpoint is fairly clear, which is Google Pay or the super apps in the East. The framing there, and in my background, I've worked a lot with financial advisors and wealth management, which has a very different tilt to it from capital markets. But the framing there is always, how does an individual achieve their financial goals? How do they do this in a risk adjusted way? How do they have a healthy set of financial outcomes? And there's almost an allergy to trading, to chasing returns, to when you talk to a lot of financial advisors, there's an allergy to things like buy now, pay later, like to Affirm, right? Because they put people in the hole for things
Yeah,
that they shouldn't be buying.
yeah,
And so for me, it's been really interesting to come into the space and get an appreciation for it,
yeah,
because what I realize is, think about DeFi as, you used to have these capital markets. The machinery of capital markets is uh, large investment managers, large investment banks, trading desks at Morgan Stanley, high frequency trading firms, the exchanges. All of that machinery generates equities, or it generates fixed
yeah, yeah,
income. and then that gets packaged up by asset managers into funds, and
Yeah.
those funds
Yeah.
get into asset allocations,
Yeah.
and that's a decade long process. And we're now in kind of like this weird place where this is I think a I'm stealing this from
Yeah.
the Bloomberg dude, but something like 20% of all equities are owned by the top three asset managers just in index funds. So the traditional capital markets and that whole factory is driven us to a pretty weird outcome. And now when we look at DeFi, what we see is globally lots and lots of hackers from scratch building capital markets machinery, which
Mhm.
is like the Linux of capital markets machinery.
Yeah.
Like you can make any exposure you want and package it however you want. And so I feel like people just have to take a much more
Yeah.
like a lens, like a forgiving lens here.
Yeah, let me so Lex, this is a fascinating topic, right? Because I come from the other side. So I worked in capital markets tech. I was pricing and risking some of the most exotic derivatives the world has ever seen in Tokyo. Interested exotics and whatnot. So I come from the other side, and for me it was really frustrating that everyone in fintech, what we call fintech, was either doing payments, right, or doing some kind of mobile app on something, and they're not really changing much, if you ask me. And I know you will disagree with this, but it's always been very frustrating for me that the core capital markets infrastructure has remained unimpacted more or less by this whole fintech revolution, and nobody has tried in the traditional, and I'm already saying traditional because it's been 10 years. Nobody has really tried to rewire the back end infrastructure, right? So people are building APIs, people are building apps. People haven't really tried to say how is capital distributed, how is wealth created in the how do we allocate capital to applications far more efficiently, how do we make capital more efficient, how do we take the assets from the real world, whether those are things like gaming or art or whatever, and how do we sort of capture this? So finance doesn't exist in isolation, right? Capital markets make value, enable value to be monetized, distributed at scale, and directed to relatively more efficient uses based on. So for me, I think when I saw this, and Joe, right, and I keep referring to Joe because he saw this coming a long way, long way ahead of most of us. And he back in 2016, he was saying things like, Ethereum will help capital be directed to its much more efficient users, and Ethereum will unlock capital and so on. So I didn't see that coming. And for me, what DeFi really does is it starts to complement fintech. It starts to build this whole backend infrastructure, the back office, the financial instrument creation, the lending, the market makers, the risk taking through derivatives exchanges. So all of these financial instruments that are not seen by the average consumer through apps like Revolut or APIs like Plaid, that also needs to be finteched out, if you will, right? That needs to be
Yeah.
digitized and that needs to be rebuilt. So I think it's great that DeFi is doing that because the other guys are already doing all this funky mobile app and API stuff.
Yeah, I mean, we don't disagree on this. I think this is super core to my framing and thesis of the space as well, right? Going to sort of like this is the manufacturing of the financial product.
Yep.
Distribution, putting it into a phone, that's fine. And we've put a lot of stuff into the phone, and you can get a loan from you can get a loan from the Bancor in a lot of you can get a loan from the Bancor in Chime, you can get it in MoneyLion, you can get it,
Yep.
etc. You can get payments from Visa in a lot of places,
Yeah. Yeah.
and it's great that sort of uh, the software distribution ate the world, but
Exactly.
manufacturing of finance hasn't. And this is kind of the thing about, as we're going a little bit off track, but I like this direction, which is this is the thing about the internet. The
Yep.
internet is for information. It's the internet of information,
Yep.
and here we have the internet of value.
Yep.
And one of the sort of, let me try to open up this topic a little bit. One of the idealistic ideas of the internet, the sort of like utopian 90s ideas, ended up being one of the worst things about the internet. Um, I had this professor at Columbia Law who wrote the Dot Communist Manifesto, so you can imagine how it's going to go. And the Dot Communist Manifesto said, um, with the advent of the internet, we have taken the intellectual labor of of musicians, of academics, of artists, of creators. We have turned it into bytes, and we have made it free for all. And so the $250 physics textbook, only available to rich Harvard students, can be now given to kids in India and China for free, and at scale to billions of people. And it's this peer-to-peer revolution, kind of turning private capitalist goods into public goods. And the communism is in the distribution of all the goods. And the unintended consequence of this utopianism has actually been horrible,
Hmm.
because it broke the humanity of economics. Like, humans no longer can understand what our economics are,
Hmm.
because what zero marginal cost goods distributed at scale to everybody, you have infinite supply and infinite production of everything. And the way that we've handled that is to have a monopoly artificial intelligence overlord that curates the infinite abyss on our behalf. Like, we can't consume and choose infinity. We need to choose from a list of 5 things. And so we bow before TikTok or
Yeah.
Google or Facebook to tell us what our life is. And of course, all of that is purchasable as attention, and so on and so forth. So, like, the utopianism of infinite goods has created these curation robots that are impenetrable. $2 trillion in market cap for Apple versus 20 billion for Deutsche Bank, right? And so Web3 shifts this in a really interesting way, because it's also so utopian. And you have this like collectivism of owning capital markets infrastructure, owning the decentralized autonomous organization,
Yeah.
of being able to be in a community and benefit financially from it. But what you're doing is you're collectivizing the most capitalist thing of all, which is a software-based property rights system. You're like this. The infrastructure is collectively owned and it's immutable, and then the exchange, the economy on top of it, becomes a human economy again, because digital goods are scarce and you can trade them and all of this. And so I don't know. I just kind of got lost in these missions that start out so positive end up having these really strange outcomes.
Yeah, yeah, that happens, right? I mean, that happened with the French Revolution. That happened with the Russian Revolution. I mean, Stalin came online, and I think if you read a people's history of the United States, it's a lot less kind to the popular media's view on how well the U.S. capitalism has evolved. And in recent years, even fintech. Experts like Brett King have been very critical of how the U.S. capitalism is shaping up, and for a good reason. So a lot of revolutions have unintended consequences, and almost all do, if you ask me. And I mean, I'm not going to go too deep philosophical, but there is this whole idea of dialectics, right? Hegelian dialectics, where you have where things start in a certain direction, there is a natural reaction to those, and then you get to some level of synthesis, and that creates this whole thesis, antithesis, synthesis idea. So I have a very abstract philosophical view on these things. I don't think these things are good or bad. You kind of see both currents at the same time. So for example, in DeFi, you see so many interesting applications, so much innovation, so many so much access to users to do things that they weren't able to do before. Brand new financial products like flash loans, which essentially are used for arbitrage and to make things more efficient. So you're right. I mean, with internet, we saw the same thing, right? Google, incredibly powerful. I mean, is a much better dad when it comes to teaching my kids than me. I mean, usually gives the right information. Usually, Facebook keeps me connected with my family. Brilliant, right? And before we had Facebook, there was just I was paying $3 per minute for a phone call in 1998. Right now with Facebook, WhatsApp, it's all free, and we are connected all the time. It's just beautiful. Right now, you and I are recording this thing, and it's enabled by the same technology and applications that all this incredible innovation has created. Is it good or bad? It depends. So I tend to take a this dialectic view where it's a point in time equilibrium and not a not a final state. We're never in a final state. So let's see how things evolve. And the other thing is, look, technology, in my opinion, doesn't exist in isolation, right? So quite a few things we are creating in DeFi essentially reflect the same ideas that have been off chain or been implemented through corporate governance ideas, through traditional legal paperwork, and so on. You have proxy voting today, you have decentralized governance in different forms in Indian local government, in Chinese communist parties, local government. So a lot of these models exist with or without technology. I think what technology does is just make everything far more efficient and speed up innovation by giving a lot of people access to building new things without having to be hired by a bank. And so if you wanted to create a new financial application that was worth anything back in the day, you had to be hired by Goldman. You had to be a quant at Lehman. You had to be go to Harvard first or Berkeley first. Now you could be a degen developer in the middle of nowhere in India, and you could create something totally fascinating in DeFi, right? I mean, how democratizing is that? Now, if that guy ends up becoming a trillionaire tomorrow and wants to take over all of Ethereum by buying everybody's tokens, we're still going to be humans. But I think it's going to be a lot more transparent, and this whole dialectic moves much faster. So we're going to see the same sort of economic forces appear in DeFi that we see off chain and without any of this tech. You'll have people. So I'll give you an example. Right, in the Aave protocol, we have this idea of guardians, and what the guardians are five very well known people, who have a public reputation to protect, who are known as significant contributors, people like Tarun Chitra of Gauntlet to this whole DeFi ecosystem. And what they do is they have a veto power on governance proposals that might be malicious, right? So if there is somebody who wants to to make a code change or a risk parameter change that's completely not right for the protocol's stability or sustainability, then the guardians can look at it and say, "Oh, we're not going to do this," right? So so these ideas have existed in the real world before any of this tech was there. But with this tech, we're just doing this at global scale, and we are able to connect people who don't even need to know each other to create some fascinating, economic and financial applications. I think that's pretty powerful.
Yeah. And I think it's important that it's not 0 to 1 in the sense that, like, either it's the Supreme Court or it's nothing. I
Exactly.
think it's fantastic that, a project that has quite a lot of value in it, mid cap, large cap, however you want to think about it, um, is is literally run by a government or a governance system that takes philosophical and practical roots from how people have organized themselves over time and implements that on top of software development. That's super novel. Like,
Yeah,
nobody's trying to replace the Supreme Court with the DAO right now, but
not
the
right
fact
now.
that these experiments are happening all over is really, really cool. The other thing I've been kind of thinking about is um, the central bank digital currency stuff. Like, everyone, if you're an economist and you have an idea about, well, if we use this ratio, that creates the better money supply and inflation and so on. What you do today is you write a paper and then you spend 60 years until you can try to, get a seat somewhere and implement it. But most likely you won't implement it. And then you look for kind of economic shocks in countries that naturally happen to their currency, and then use that as sort of econometrics data to defend your argument. But if you look at DeFi, there are dozens, if not more, projects that are, building different stable coins with different issuance parameters and rebalancing or rebasing parameters. And it's like, you have a lab for central bank amoeba.
It's
You
so
have a
true.
lab for people actually implementing the various,
Yeah. So
ideas like that. Right?
I'm glad you brought this up, right? So I have a history here. I worked on a project for an audit firm. It's There's a project that NASDAQ were trying to build called Link, right? And at PwC, we were doing this audit piece for them on tech audits, and they had a truly ambitious vision of rewiring securities markets. And unfortunately, the tech was, it was a bit early. Some of the tokenization ideas weren't there on chains blockchain. But the core concepts, as to how the whole securities markets value chain, all the way from issuance down to trading and settlement, can be much more efficient, was there, right? I mean, and these guys knew exactly what they wanted to do. They had a regulatory roadmap that was minimum 5 years long, and 5 years have already passed, right? So, if and it was really frustrating to be part of all of these projects where, innovators from within these large institutions, whether they're banks like Deutsche Bank, they were doing VTrade, or HSBC, they were doing VTrade. People who were doing Congo back are doing Congo. They're really great innovators in these institutions who want to make a change, but there is just so much weight of the legacy system, right? There's so many barriers, there are so many entrenched interests, and just that DeFi kind of says, look, we're not going to solve the last problem. We're not going to solve this, every single problem first. We're going to build the core of the system. So lending, right? Automated market makers, core derivatives trading functionality, margining, fixed rate loans, interest rate swaps, right? Let's just take the basics. Let's just rewire this infrastructure from the first principles on a public blockchain. Tokenize. We used to talk about tokenization, right? Lex, you and I have spent so much time with institutions on talking about tokenization, and we just go into meetings, working groups, conferences, with lots of people just pushing paper all day and having deep intellectual discussions without actually writing a single line of code, right? And that was incredibly frustrating. With DeFi, what's happening is that people are just building, and people are building at light speed, and none of that. You don't need to have a fancy job and a degree from Harvard and whatnot, or from IIT or whatever, to participate in this system. So you don't need to be part of any of that privilege, or that license permit privilege. You just go in. If you can build, you build, and that's incredibly democratizing. And I feel very emotional about it.
Yep, totally there with you. So I do want to I think risk and compliance. It's no one likes talking about compliance, but let's talk a little bit about risk. So we're kind of anchored in capital markets, and so we're not taking the perspective of like, should an individual investor buy this? Is it good for them? That's essentially out of scope, right? Like what's in scope is issuance, capital distribution, connecting with capital that wants to invest in projects, and the map of capital markets, like you say, is really getting explored and imprinted on the space. So where you're starting out with, how do you trade on a decentralized exchange, and then you get to how do you margin trade, and then you get to how do you do insurance on top of it. We're now kind of in a place of how do you tranche risk, and I've seen at least one, and I'm sure there are, another 10 in the wings, projects like Barnbridge that are tranching the cash flows or the interest of various decentralized protocols into instruments that are essentially securitized and then have different return profiles. So just like as a basics
Yep.
setting,
Yep.
the place where the returns come from, the yield comes from, it's a clearing rate on supply and demand for leverage, right? So you
Right.
have a shallow market, somebody wants to borrow, somebody wants to lend.
Mhm.
Same if I want to do that with Apple at Morgan Stanley, right? I want to borrow some Apple, there's some interest rate. So that's where the interest rates are coming from, the margin
Yeah.
functionality.
Demand and
In
supply.
other cases, you get interest from essentially what's like a dividend, right? The yield farming stuff, a dividend that people are encouraging use of a particular protocol. And then, what the tranching does is it kind of prioritizes filling up some particular fixed interest rate in A, B, C, D, and so on. To me, it's being at Lehman in 08, mortgage-backed securities are a dear topic, and so it's super familiar as a
Yeah.
source of like disconnecting um, risk from distribution and causing all sorts of stuff to blow up. How do you think about securitization in the DeFi space, and is it good? Is it bad? And like, what should we watch out for?
Yeah, so look, I mean, Aave and Aave is is a fundamental building block of the DeFi system or the ecosystem. We do pretty simple things. We do collateralized borrowing and lending against a pool. So what Aave is, let me just explain Aave before we go into the more advanced bits. So Aave allows anyone to deposit a certain set of assets into a lending pool, and then if those some of those assets qualify as collateral, then you can actually borrow against that collateral. And you're exactly right. The yields or the interest rates come from the demand and supply for various assets within this pool. Now, the other thing Aave does is it tokenizes everything, right? So your deposit position is tokenized, and you can see with every Ethereum block issuance, you can see that if you deposit USDC, you get an AUSDC token, and then that AUSDC token goes up in value. Similarly, when you deposit money, if you post collateral, then that your credit line is also effectively tokenized, so you can essentially use that for off-chain lending because you're getting a credit line from a lending pool. And then there is a lot of functionality around being able to swap collateral if your views on the market change and so on. So it's a pretty simple, fundamental, highly scalable building block of the overall DeFi ecosystem. Now, obviously, on top of this, there are people who are building things like interest rate swaps. I think Swivel is a great project to look at. Not a recommendation, but love those guys. Notional are building some fixed rate loans. There are protocols building asset management products, and you said there are people who will try to tranche these risks and securitize. And you're right. I think to some extent at that level, and that's kind of a level above from where Aave and some of the other fundamental building blocks of DeFi sit. We're going to see similar sort of risks, right? So if you take an example where someone issues a stable coin backed by unencumbered assets in a protocol, right? So let's say there are unencumbered assets in Aave, and those someone issues a stable coins against those, and then those stable coins are then used in another protocol, and suddenly you can't really trace credit linkages, right? I mean, who is lending to who, and what's the total borrow position? Are we over leveraged on? Is there a systemic risk here? So yes, those types of things can happen, and once those systemic linkages build up, then what can happen is, let's say somebody's large position gets liquidated in one protocol, and then suddenly they need to pull money from another protocol that leads to another. So I think we have some of the similar sort of risks in DeFi because, as I said, the finance is the same, right? If you get Uniswap liquidity tokens, lock them in another protocol, and suddenly you can't trace your own assets. I think hopefully that won't happen. So what we are seeing is we're seeing a lot of people work on analytics and transparency, right? So Nansen AI, Dune Analytics, BitQuery. There are quite a few very Masari. There are quite a few people who are building some really interesting applications in the risk and transparency space. And these things, and here is the beauty of it: they have access to all of the data, they have access to all of the smart contracts, they have access to all of the tokens where they are held, right? Who holds what. So unlike the financial system, back in, you were at Lehman, I was at Goldman, and Goldman nearly had the same sort of near death experience, but that was because of lack of transparency. The financial system wasn't in that bad a shape. In fact, when PwC worked on Lehman's recovery, it was an incredibly profitable project for everyone, right? I mean, Lehman actually had far higher quality assets than people thought. It's just that nobody knew.
No,
I
no
mean,
need to rub it in. Alvarez and Marshall. I think being CEO of Lehman Brothers from 2009 to 2016 was like a really good gig.
yeah, the system froze. The system froze because there was no transparency. It's not that we were in that deep a hole as an industry. It's just that we just didn't trust each other because we had no idea what was going on. With DeFi, we know exactly what's going on, right?
Yeah.
If a developer writes some code, we know where the risks are. We know the risks today.
Yep, absolutely. I'll point folks also the DeFi score, which is another project that ConsenSys does that looks into the sort of smart contract risks and other risks of protocols to try and, because you don't have counterparty risk in the same sense, but you there is something there because these are, end of the day, like the equivalent of structured notes on structured notes against each other. So there's lots of novelty. It's a super exciting space. Look, we've explored some really great topics. I want to thank you for joining, and definitely want to do this again.
Always a pleasure, Lex. So for our audience, please go to aave.com. Ideally, get a MetaMask wallet, put some Ether in it, put some stable coins in it, and play. Right. The best way to learn about this space is to play with it, and it doesn't actually cost a lot of money or time. Just go to aave.com, play with the protocol, and experience it for yourself. Any questions, please do not hesitate to ask.
Well said.
Thank you
so much.
Cheers. Bye.
Hi, everyone. That's it for this week's episode of the Fintech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.